Hello and what is going on, lovely people of the internet? It is HOOTMONEY here with another video for you guys today. Today we're going to be talking about potential risk in the stock market. We always talk about the enormous amounts of gains that you guys can make by being an investor in the stock market, but we need to talk about the risks as well, because with immense rewards there's always going to be some risk involved. So it's important that we cover everything and not just cherry pick the good information. So hope everyone's having a wonderful Sunday today. Cheers to you guys. You may have noticed I look a little bit different now. I don't have my beard anymore. Honestly feel pretty naked. I got a nice faded haircut, so I look a lot different today. And yeah, bear with me for a little bit. I look about 10 years younger, but still the same person, same knowledge here. So yeah guys, I hope everyone's enjoying their Sunday. I'm about to watch the Euro final today between Italy and England. Go Italy, baby! Italia to the moon! So a little off topic, but I actually have some Italian background and I will actually be in Italy 1 week from today, so maybe we'll be getting some vlog action on this channel. We'll see. But anyways, you guys are here for the upcoming market crash and the information and what you guys need to know to protect your portfolios and how to deal with this type of risk in the market. So anyways guys, if you guys want to join my Discord server, we talk about the stock market, the risk involved, different day-to-day plays, day trading plays, and etc. We've got a lot of money makers over there, and the Discord channel is absolutely free. It's my gift to you guys, so join that using the link in the description or in the pinned comment section. And yeah guys, without further ado, let's get right into the video. Alright guys, so there's been enormous amounts of talks by huge investors about a market crash that is coming in the coming months, and there's tons of people scaring everyone's panicking, and there's tons of fear and volatility that has come out of this, and people like Michael Burry has been saying that the market is dancing on knife's edge. So obviously there are these huge risks involved in the overall stock market, and you'd be very naive to believe that stocks only go up and they can keep going up, and the S&P 500 can keep going up 60% year over year, because unfortunately that's just not how investing works. We're in a period of a lot of euphoria right now in investing, and perhaps it might slow down in the future, or there might even be an economic crisis, which many different investors have predicted. So you guys can see Michael Burry, Jerry Grantham, and other top investors are predicting an epic market crash. Rich Dad Poor Dad author Robert Kiyosaki warned of a historic market crash is coming, trumpeted Bitcoin and channeled Warren Buffett. So these two investors, Robert Kiyosaki and Michael Burry, they both have differing views. They both think the stock market will crash, but Michael Burry also thinks Bitcoin and cryptocurrencies is going to crash. And Robert Kiyosaki, Rich Dad Poor Dad author, he thinks that Bitcoin is going to moon. And people have differing opinions. Well, this economist, Nouriel Roubini, another guy who has predicted the 2008 market crisis, warns of a train wreck and stock market crash and stagflation. And this was actually the most interesting article that I read on this, so we're going to be going over some of the best points from this article. So he is an economist that correctly predicted 2008 financial crisis, just like Michael Burry, and he's now warning of another market crisis. So he stated that the same loose policies that are feeding asset bubbles will continue to drive consumer price inflation, and that conditions are ripe for a double whammy of the stagflation of the 1970s and the stock market implosion of 2008. So an important term that this article keeps mentioning is stagflation. So we have to know what exactly stagflation is, because perhaps you guys have heard of inflation, where the purchasing power of the dollar goes down, or deflation, where the purchasing power of the dollar goes up, but you don't really know what stagflation is. So we're going to go over this right now. We're looking at Investopedia, which is a great website to learn about investing and just get free information on investing and finance. So I definitely really highly suggest you guys just Go around Investopedia and just read things. But anyways, guys, stagflation is characterized by slow economic growth and relatively high unemployment, or economic stagflation, which at the same time is accompanied by rising prices or inflation. Stagflation can also alternatively be defined as a period of inflation combined with a decline in gross domestic product. So essentially what stagflation is when there's inflation in the economy, the purchasing power of the dollar goes down, things cost more money. Your Big Mac now costs $10 instead of $5. But it's also when economic growth is not continuing to climb. So there might be supply chain issues, which is what we have seen during this year. Things like lumber, you can't get out lumber fast enough to build these homes. Things like the GPU and the CPU shortages, so these chip shortages that we have seen, they just can't meet the demand of the economy. And also the labor shortage that we have been seeing in 2021. You can't get enough people to work these jobs as demand increases in the economy. There's tons of demand in the economy, which is driving up prices, driving up inflation. But the corporations, the companies can't meet these demands. And with that, we cannot meet the target of economic growth that we need to meet the demand in the economy. He goes on to say that the warning signs are there for the global economy and central banks will be left in an impossible position. Today's extremely loose monetary and fiscal policies, when combined with a number of negative supply shocks, could result in 1970s style stagflation. If you won up to $70 in free stock just for signing up and depositing at least $1, use the links below in the description or in the pinned comment section to sign up for Public. Public is a stock investing application / brokerage / social media where you can buy and sell stocks, post it to your feed, follow your friends, follow influencers like me, famous people as well, and see everyone's portfolios because, well, it's all public. Public is a great application. It's very easy to use, very great user interface, and they have amazing customer service. They rely off of your tips alone, so it's just like how a waiter is going to give you the best service at a restaurant. Public is going to give you the best service as a brokerage. They don't sell your trading data. They don't do payment for order flow. So you know you're going to get that best service. Anyways, guys, you're getting up to $70 in free stock just for signing up and depositing at least $1. So it's basically free money. So use those links below in the description or in the pinned comment section to sign up. And let's get back into the video. So right here we have a chart of the 1970s stagflation crisis, and it's basically plotting out unemployment and inflation, and it goes from 1973 all the way to 1981. And as you guys can see over here on the left hand side of the chart, you can see the change in CPI over the past 12 months. So this is the inflation chart. As you guys can see, this red line right here, and then on the right it's showing the unemployment percentage. So as you guys can see, in 1973, inflation and unemployment were relatively low compared to where they were in 1982, where they were at much higher values. He also argued that debt ratios were much lower in the 1970s than they are right now, and that this upcoming crisis will be much worse. Debt ratios are much higher than in the 1970s, and a mix of loose economic policies, i.e. the Federal Reserve, and negative supply shocks, the chip crisis, lumber, etc., threatens to fuel inflation rather than deflation, setting the stage for the mother of all stagflationary debt crises over the next few years. So guys, he's bringing up these debt numbers, and yes, that's very true. In the 1970s, there wasn't as much debt used in this economy, and there is absolutely an absurd amount of debt in the economy today. Ever since the 2008 financial crisis, debt has skyrocketed to absolutely astronomical numbers with the lowering of interest rates. So that means it's very, very cheap to borrow money right now, and borrowing money is what debt is. So when it's cheap to borrow money, debt goes up, and that's what's basically been happening over the past 10 to 15 years. So this chart right here from the Federal Reserve shows that the federal debt as a percent of the gross domestic product. So you guys can see right here, this grayed in area, that is the 2008 financial crisis, where it started to plateau just a little bit, and this was over 100% of the gross domestic product. And then we saw in 2020, federal debt skyrocketed to new all-time highs, being at almost 130% of the gross domestic product. So, with the cost of borrowing money so low, people like to borrow money and invest it because let's just say you buy a treasury bill, right? You buy it for $100 and in a year you're promised to get $101, right? Well, no one really wants to earn only $1 on $100 in a year. Besides the Federal Reserve, they're the only people who are really buying these bonds. But there are people on the other side of the trade borrowing $100 from a bank, promising to pay back $101 in a year. And this is a very, very cheap way because you get $100 up front. You can invest that money, make 60% on the S&P 500 in a year, pay back your debt of $101, and there you go. You just made a lot of money for basically free. You only had to pay $1 as the cost to borrow that money. So a lot of people are arguing that since the cost to borrow money is so cheap and debt has gone to absolutely insane levels, it has been fueling this absurd rise in the stock market, in home prices, etc. Now, since debt is at an all-time high, this raises the question of whether or not debt could crash. Now, what would cause debt to crash? Well, that would be higher interest rates. If you owe more money in the future, instead of owing $101 in the future, you now owe $107 in a year. People are less likely to take on risk and more likely to pay back that debt. So if that debt is stuffed away in the S&P 500 index and now interest rates go up, then people will want to pull away that money from the S&P 500 and pay back their debt. So this could cause a market crash because the S&P 500 or the stock market or individual equities are being boosted up by this enormous amounts of debt and the cheap borrowing of capital. For now, loose monetary and fiscal policies will continue to fuel asset and credit bubbles, propelling a slow motion train wreck. The warning signs are already apparent in today's high price to earnings ratios, low equity risk premia, inflated housing and tech assets, the irrational exuberance surrounding special purpose acquisition companies, the crypto sector, high yield corporate debt, collateralized loan obligations, private equity, meme stocks, and the runaway retail day trading. At some point, this boom will culminate in a Minsky moment. A sudden loss of confidence in tighter monetary policies will trigger a bust and crash. So what he's basically saying is that the Federal Reserve will have no choice but to tighten up monetary policy by raising interest rates, and all of these things will start to fuel the collapse of the stock market, meme stocks, cryptocurrency, pretty much every single asset class. Now, there are other risks that the economy is facing in terms of its growth over the next few years. Like I already mentioned, the economy needs to be able to grow at an immense rate in order to fuel the current demand that we are seeing. So there is a labor shortage. If you can't find people to fulfill these jobs, then the economy can't grow, as you do not have people fulfilling the jobs that are needed to actually grow the economy. We also have China cracking down on stocks that trade on US exchanges such as Alibaba, Tencent Holdings, and Didi. This is a risk because this makes up about $2 trillion in market cap, and to put that in perspective, that is more than all of cryptocurrency combined. We also have Wells Fargo telling customers that it's shutting down all lines of credit. What a credit line is essentially a line of debt. It's a promise from your bank that you can take out a certain amount of cash and use that cash as long as you will pay it back in the future. So that's what a credit line is, and Wells Fargo is now shutting down that option for personal lines of credit. And what this could signal is, well, the start of the reversal in debt. And with debt being at an all-time high, and I already explained how the collapse of debt can collapse the economy, this is definitely a huge risk. We also have the coronavirus Delta variant spreading across the globe, and Tokyo issuing restrictions, state of emergency, shutting down all Olympic travel to their country, and no spectators at the Olympic Games. And this is another risk, although I think this is more of a temporary than a permanent risk. So guys, this is all scary stuff, especially if you're heavily invested in the stock market. If there is a huge stock market correction, you guys could lose like thousands and thousands of dollars. So it is important that you guys know how to protect yourself and be a prudent investor. So what exactly can you do? You can buy put protection. Now, this is a bit of a speculative way to do this, and put options are sometimes very, very risky, especially if you don't know what you're doing. But if you buy a put option, it helps you be able to make money while the stock market goes down. Now, while you guys can do this, I don't really think it is the smartest thing to do because, well, timing the stock market is not always the best thing to do. And oftentimes, people lose betting against the stock market. Michael Burry, the famous investor, he's bet against the stock market many times since 2008, and well, he has lost. His most recent bet was betting that interest rates would start going up, so he bet against the US Treasury bonds, and he bought puts against the US Treasury bonds because if rates go up, the prices of bonds go down, so he was betting that the prices of bonds will go down, and well, recently, the prices of bonds have been going up, and we have been seeing lower and lower interest rates. So betting against the stock market is not always the best thing, and it costs money to bet against the stock market, so you really have to do it at the appropriate time, and no one knows when that may be. It's a very good possibility that we continue to see the stock market rally before we see the stock market crash. Another thing that you guys can do is hold 10 to 20% cash in your portfolio, being prepared to buy the dip. Now, when I say to buy the dip, I don't say to catch a falling knife. If there's a huge event that creates a market sell-off, a market crash, it'll be pretty evident in your portfolios. So don't just buy back in right away. Have some cash on the sidelines and deploy it each and every single week, and then eventually you will dollar cost average your way back in to this lower priced stock market. And this is truly the best way to do this because people who invest over the long term are usually the people who make the most money while investing. So if you just get that average price over the long term in the stock market will likely go up in your favor over your lifetime. The third thing to do, and this is also risky, but I like it more than just buying puts on your portfolio, and that is buying Bitcoin or gold as a hedge against inflation. If you're very risk averse, go with gold. If you're risk on like me, then go with Bitcoin. I recently bought more Ethereum, and I plan to keep dollar cost averaging into Bitcoin as this thing goes on. I don't know where the prices of Bitcoin is going to go in the future, especially in the short term, but I know for a fact over the long term it is something that I want to own, and it is definitely a hedge against inflation if we do see continuous inflation in the future. So while all of this does seem a bit scary and it might scare you off from investing, don't let that be the case because there are definitely ways to deal with this. I think it is scary of a global economic crisis and a debt crisis and stagflation and all of these terms just being thrown at you. But if you are an investor, you have to be aware of these risks. I'm not just going to throw at you guys that investing is all fun and rainbows and that everyone's going to get rich, because honestly, you need to have patience while investing and you need to be in this game for the long term, or else it might chew you up and churn you out. So I really hope that you guys learned something and you're not going to just be blindsided in case something does happen in the future. Again, I'm not predicting a market crash, but I do think it's important to be aware of the risks that you have as an investor and not just think that it's a one-way streak to make a bunch of money, because it's very apparent that there are risks. Anyways, guys, I hope you guys enjoyed the video. I enjoyed making it as always. I hope you guys learned something today. And yeah, guys, this was a long one. So if you guys made it to the end of the video, I highly appreciate that thumbs up on the video, as it's the #1 thing you guys can do to help me out. And also check out those links below to sign up for Public, where you get up to $70 in free stock as long as you deposit at least $1. Guys, that's about it for the video. I hope you guys enjoyed. Peace.